Mark joins us now from Westchester, Pennsylvania with more. And Mark, before we get to that, I want to get your reaction to the GDP numbers. It was a complicated report. What stood out the most for you?
Well, it was very near expectations, but it is disappointing that rate of growth isn't sufficient to start to bring down the rate of unemployment. We need growth that's closer to 3% plus for that to happen. And in fact, until that does happen, I think we need to be nervous about the staying power of the economic recovery. And one other bit of a little bit of disconcerting information in the report is that a lot of the gain was related to inventory change, and of course that's not something that's going to power growth going forward. So Q3, the current quarter, and Q4 are going to be on the soft side.
Yeah, what kind of assumptions, not just about the U.S. story, but about the global story, do we need to revisit because of this GDP report?
Well, it goes to the concerns, the reasonable concerns that the economic recovery is not engaging in a self-sustaining economic expansion, that we're not off and running yet. And given the obvious risks out there, like the European debt crisis, like what's going on in the housing market and the potential for more house price declines, like the continuing cuts at state and local governments and the potential for tax increases, all those things are reasons to be nervous about the recovery, particularly given the fact that the recovery is still so fragile.
Business spending, manufacturing, perhaps the bright spots in the economy right now. How long can we see that driving the recovery?
Well, even manufacturing is the rate of growth in manufacturing is starting to slow. As you know, a lot of that inventory gain was in manufacturing and provided a nice boost to manufacturing output and employment. And manufacturers can't continue to count on that inventory gain to power growth going forward. So one of the reasons why the broader economy is starting to slow is because manufacturing growth rates are starting to slow because that inventory swing is over.
Right. What I find interesting is that the view on Europe seems to have brightened a little bit. It's not as depressed as it was a couple of weeks ago, whereas the view on the U.S. has turned a lot darker. Are either of these accurate right now?
Well, certainly the concerns about the United States are, I think, correct. We need to be nervous. In the case of Europe, I have been surprised at how well the European economy performed in the second quarter and how well the European policymakers have responded to their own crisis. I mean, the fiscal austerity plans that each of the governments are putting forward seem credible, and they're starting to execute on them. I would anticipate, however, given the hit to European stock markets and the weakness in the European banking system and the fiscal austerity plans themselves, that the European economy will weaken later this year into next, and is one more reason to be a bit more nervous about our own economic recovery later this year and into early next.